Hello, investors. It's Don Vandenbord, Senior Portfolio Manager with Revere Asset Management. Today is Friday, November 11th. Happy Veterans Day to all the veterans out there, especially. I'm very much aware that freedom isn't free and definitely appreciate every single one of you. Since it's Friday, this is the Revere Market Insight Video Big Show. That's the Friday edition where we take a look back at the prior week, take a look ahead at what you need to know for next week, and update the world famous 21 over 21 leaders list. Let's get right into it. We've got an updated market state. Correction gone. Correction with short-term uptrend gone, showing bear market rally now. The signal for that being that we're still under the 200-day moving average on the S&P and the NASDAQ, but we're above the 21 and the 50. Good enough to me to be a bear market rally and get rid of the correction. How far it goes, we don't know. We're coming into the 200-day moving average where we failed miserably last time, and we'll see what happens when we get there. But there was good and bad in the market today, even though the final numbers were all green. Let's check the trend gauge over here. Leaders staying bullish uptrend. We're upgraded today. The short term 21-day exponential moving average. This means all 5 of the major indexes have at least 2 closes above it. And the 50-day moving average, again, that means all major averages have at least 2 closes above it. In this case, the laggard being the NASDAQ 100. But accomplished that today with close number 2. Also nice to see a close at the end of the week above it. So those go from neutral to uptrend. Long term, we're still on bearish. We do have 3 of the indexes above, but the NASDAQ 100 and the S&P 500 still below. So we're showing a green arrow clicking over into neutral, but still technically under the 200-day moving average. And as anybody that listens to these videos know, that is where we continue to keep a defensive posture. This is where all severe bear markets occur, and we're not going to ignore where we are. So what happened today? Little gap up at the open, about 0.25%. Pulled back, tested, but big rally in the middle of the day, pulled back for a while, and then rallied again into the close. But what led was tech, absolutely tech, NASDAQ 100 leader, G6 led, but a lot of it was junk. And I know this because ARK-K was up 8% today after being up 14% the prior day. That's a lot of short covering in a lot of extremely weak tech names. So that's what led, and it was also obvious from right out of the gate that there was a lot of rotation going on. And this is why I'm such a big proponent of having a core position in the S&P 500. I've said several times, all the rotation takes place within the S&P 500. And what we saw was money coming out of staples, utilities, healthcare, real estate, and industrials, and going into tech, out of value into growth. But all that rotation has taken place within the S&P. And if you're leaning too heavy to one side in your portfolio, either growth or value, this is the day that you can really take it on the chin. And we preferred a smoother equity curve, and we're willing to give up a little bit of a gain to eliminate big losses on certain days. And then your emotions come into play, and you can get taken out on bigger than normal single day corrections. We're always fighting that battle. So big major rotation, but again, it occurs within the S&P 500. So the final numbers on the day: G6 up 2.13%. It led second day in a row. S&P 500 up 0.9. NASDAQ 100 up 1.8, was up over 2% at one point. Dow just rallied at the near the close to finish positive, was down nearly 1% early in the day, as there was some big selling going on in some of the big names in the Dow, the high price names. But did finish positive. Mid caps up 0.6, Russell 2000 small caps up 0.8, global diversified 60/40 stock and bond up 0.8%, in-house up 0.2%. I want to point out where we are in the market conditions. This is very typical of what happens when you're in the process of going over from a severe bear to an early recovery. And the expectation is that our portfolio is going to have moderate underperformance, and that's exactly what we're seeing right now. It's not a surprise. We see it all the time. I basically, throughout history, have gone through and come up with these 9 different types of market conditions, and this is how we perform relative to the S&P 500 during these types of market conditions. We're right here now, moderate underperformance, no question about it. Bear market, we've already proven the major outperformance. We were down at the worst 10% or 8%, a little bit more since then. But when the index was at its maximum to the downside, 27.5%, we were down 8%. And then these various flavors of pullbacks from a bull market. Maybe we're in the early stages of a bull market here, and what we'll do if we are is we'll transition from moderate underperformance to inline or minor outperformance as we jack up our beta above the equivalent risk of the market. Right now, being under the 200-day moving average, we kind of keep our exposure below 1.0. In other words, the equivalent of what the S&P 500 is doing. But we're hopefully transitioning from this early recovery of the bear market to an early bull market. And then if growth stocks continue to lead, we'll go to moderate or major outperformance, such as we saw in 2020 after COVID when growth stocks were cranking, and so was our portfolio. But I wanted to make that comment on the market conditions that we're under and what the expectation should be. So we'll also do the tail of the tape and, of course, the updated 21/21 list. But let's get into now what we do here at Revere. And basically, we're trend followers. We take a look at what the market is currently doing relative to three time frames. As I mentioned on the trend gauge, as we show in every video, and when we're trending above the 3 time frames, and this is the most bullish posture we'll be fully invested there. Our beta will be about a 2.0 because we'll have a bunch of growth stocks and be heavy in the indexes. When things start to go sideways, our stops will take us out. We'll go sideways if we really start to roll over the slopes of the lines of the short term and medium term. We'll go from uptrending to downtrending, and we'll really be getting out of the way. And if we get below this black line, the 200-day moving average, as you know, this is the chart that drives our motto here at Revere. Risk management is job number 1. You take care of the downside, and the returns take care of themselves when the market gets back to a bullish posture, because you're compounding your capital from a much higher level than if you had a 27% drawdown. So that's the way we do things here. We get especially defensive, as you know, when we're under the 200-day moving average. The 200-day is starting to flatten out a little bit here. Only about 2 points a day is it going down now. The big change happened on 4/21 when we failed up into it, started the second leg down. The slope of the line rolled over. We had a bear market rally into the declining 200-day. That was a rally off of the second leg down, and right now we're in a rally off of the third leg down, approaching the 200-day moving average. And there's another key area in here that a conversation with a client astutely pointed out to me, a fib set that I haven't run for the recent high to the recent low, this 4007 area here, is going to be, it's a 61.8% retracement of this third leg down. That normally provides resistance at that level, and then above there, the 200-day moving average is now down to 4081. Less than 2.2% away from that. So there's the S&P 500, and you can see what we did today. The big move up on CPI yesterday, follow through to the upside today with a lot of sector rotation going on inside of it. So here's the NASDAQ 100. Outperformed for the second straight day among the major indexes, got above the 50-day moving average. When we pulled back a little bit at the open and moved back above yesterday's high, we added QLD. That's a long versus the, it's two times the NASDAQ 100. We've got a very easy stop there. We should hold this 50-day moving average. And money very clearly flowing into big tech. Again, the big tech part could be short covering, but if big funds need to put money to work, they've got to put it into big liquid stocks. And we all know the NASDAQ 100 are the biggest and the most liquid out there. So this could run for a little bit. We've also had semiconductors outperforming for a couple of weeks, which is a good sign for the NASDAQ 100. Let's go to the Dow Jones Industrial Average, which lagged today after leading for a while. Again, no surprise. You can see here the slope of the line the last 2 days. That's just the way it is. It led for a while as money flowed into these big multinationals. But when money flows back into tech, it comes at the expense of the Dow Jones Industrial Average, and that's what you've seen the last couple of days, despite the chart showing that it's up very nice on a relative basis. It wasn't, but then again, on a relative basis, it's strongly outperformed in addition to going higher over the prior 6 weeks. How about mid caps? MDY. Second close above the 200-day moving average. Good stuff there. And small caps, IWM. First close above the 200-day moving average. So a second close above there, we're looking at adding a long to the small caps as IWO is joining IWM in acting pretty well. Let's take a look at IWO here. This is small cap growth. You can see it got above its 200-day moving average also. IWN is small cap value. Again, above the 200-day moving average. So relative to the 200, they're acting very similar. So IWM small caps make sense because, again, above the 200, we should hold. If we don't, that means that the overall market is going to be correcting, and maybe this third leg down wasn't the bottom. As you know, there's a long way to go. There's a lot of dire predictions for recession right now. We're plain and simply not in a recession based on the preliminary GDP figures for Q3 and what the Fed and the GDP Now website is showing. But are obviously a bunch of tech layoffs. We had that crypto bankruptcy. They filed bankruptcy today, and they have actually 134 worldwide companies that were part of their umbrella that are just bankrupt now along with them because they were depending on them as kind of the mothership. But then the question is, how does that go into different institutions? We already know that the Toronto Teachers Fund lost $400 million that they had in crypto at that exchange, which is just awful. But I mean, I've always said I thought crypto was a house of cards, and a steady wind blew the cards down. I'm very aware of steady winds here living in Florida with all the hurricanes, and we dodged another one this week. But anyway, so that's where we are with the big cap indexes. Let's go to the VIX. This continued to be a good signal. We talked about that 24 to 26 area. We broke below it now. Just a little couple day bounce from oversold on the stochastic before rolling over again. We'll be on the lookout for this to get back above the 24 level. That would indicate that it might be time for a pullback in the indexes. How about bonds? 0TNX. This is the 10-year yield. That does not look right. Bonds were down today, so yields were up. This is a flaw in this chart here, and I'll bet TYX shows the same thing. Yes, it does. So let's go to TLT. As you can see, it was an inside day today, so the price of TLT down means rates were up slightly today, not significantly. More significant is what's going on with the dollar. And you can see the second straight gap down. This is really getting extended to the downside. You know what happens when you stretch the rubber band too far to the downside. It snaps back the other way. I'm doing this from a hotel room in Orlando, Florida. I'm at the 3-day Martin Armstrong World Economic Conference, and the title of the conference is "In the Dollar We Trust." So that'll give you a little bit about idea about what his outlook is. And plain and simple, for the U.S. dollar to go down, another currency or multiple currencies are going to have to show strength, and that basically means the yen and the euro, they're in no better shape than we are. I mean, I think that this is just a mean reversion here. I know I said I think. I hate saying I think. We are going to read the chart, but I've read enough charts to know that when you get stretched one direction or the other, the snapback is bound to happen, and that's why uh, we're not overly confident in this rally. Certainly not thinking we're going to go straight up when you get some things stretched to the downside like this, and it's such an interdependence on what stocks are doing versus what the dollar is doing. One snap in the other direction will have an impact on the overall indexes. Let's take a look at what gold did today. Continued higher, not a surprise with the dollar down. How about BITO? Bitcoin down another 10% today, bounced yesterday, so basically closed where it was 2 days ago. As I said, with FTX claiming bankruptcy, filing bankruptcy, the house of cards is collapsing. Let's bring up now the tail of the tape and see what's changed here. Put call. Don't like seeing this. 0.75 is very low. It means complacency. It's a little bit of a red flag. The VIX below 24, we like that, down 4.3%, but again, that's kind of getting stretched. Fear and greed up to 66, operating under the bull case with the positive CPI, the 1021 follow through day, and then the 1110 CPI reaction. I didn't mention China relaxed some traveler COVID restrictions. If you were a traveler going into China, you basically had to quarantine in either either in a hotel or in a government building, and then in a residence for 20 days, and they've cut that to 8 days now. I saw a quote from an energy analyst that said if they continue to open up like this, it'll be an extra 500,000 barrels a day of oil that'll get consumed. And there's the FTX crypto exchange filing for bankruptcy. Day count from up 1 to up 2. Safe growth and defensives very clearly sold today. Growth far outperformed value, but again, a lot of that is a junk rally. Expectations positive as long as we're over that 3,900 breakout area now, and we did see continued strength into this fib area, 4,007. We got up to 4,002 today before pulling back slightly, but a big move in the NASDAQ 100 above this key fib 286.82, and we'll be keeping an eye on this next week. It's a big fib number. It was a lot of resistance on the NASDAQ 100 on prior rallies, and that's definitely something we'll be keeping an eye on next week. Let's scroll down here a little bit. Oil's strong today, as well as CKY. Those are the tech indexes, semiconductors, software, XME. Did XME continue? Yeah, not really, though. It didn't really outperform significantly, so let's get rid of that. But dollar down, Dow finished positive but lagged on a relative basis. Biotech lagged. Actually, it didn't, lagged early in the day, but rallied, and there's a story there related to some biotech. And also a story related to one of these other sectors that lagged today, ITA. Apparently, with Elon Musk's Twitter, he's moving too fast, and they were wanting to charge everybody $8 a month to get quote unquote verified. Well, a bunch of people opened fake corporate accounts, got verified, and then they're putting out fake press releases on there. For example, one said Lockheed Martin is no longer selling equipment to some countries that they now consider evil, and LMT was down on that. Eli Lilly, somebody created a fake Lilly account and said we're now giving away insulin for free. Lilly dropped hard on that before bouncing. LMT didn't really bounce, but Elon seems to be moving a little bit too fast in his quest to, I mean, he's got billions of dollars on the line here. He deserves to try to make a profit because I mean, the business model is just changing here. He's trying to get away from an ad-centric model to a customer-centric model. And money flowed out of industrials, staples, utilities, healthcare, and real estate today, the defensive sectors. That was the sector rotation that I talked about. But again, S&P 500 up almost 1% on the day. So when it comes out of some, it goes into the other. That's why I'm fond of saying all rotation takes place within the S&P 500. Focus list will take care of when we go through the 21 over 21 list, changes we did in-house today. Steel Dynamics, Mobileye, we added to both of those, added to SSO, bought QLD, and trimmed FSLR as solar stocks took a hit today. Tech and junk, bottom line, tech and junk lead, rotation out of safe growth and value. You can see the next two levels up, the 200-day moving average and this 4,007 fib. That's what we'll be watching for next week on the S&P 500. So let's get into the charts and do the 21 over 21 list now. And as always, we start off with the stocks that got punted from the list and why they got punted. And let's start off with Lockheed Martin. Really, it closed below the 21. You can see down. Let me get rid of this and make the charts a little bit bigger. Broke the 21, down 5.4% on the day. It had a nice move up after earnings. This is really a normal pullback for it after this strong of a move. Shouldn't be surprised. But normally when you consolidate after a move up, the next move should be in the direction of the primary trend. And in this case, you could argue that it wasn't, since it made lower lows since this prior pullback on 11.4. So that was sold. Or dropped off. Interactive Brokers, 6.3% down. Another one again came to the top of this cup, consolidating. The move should have been up. It wasn't. It's down. I didn't see any news on this today as I was driving part of the day. Down 6%, clear break of the 21. Third one out is LNG, which we got stopped on this week. The entire nat gas, liquefied natural gas ecosystem took a hit over the last 3 days. Not really sure why. Part of it, one explanation I saw, and I know it's human nature to want an explanation, even though you don't need one, you have to obey price. But you can see the 4 above average selling bars here. That's a change in character for this stock. It's a failed breakout. Plain and simple, it hit the -7% stop loss. But part of it is that Putin apparently is pulling some troops back. And if there's any kind of a truce there and the nat gas spigot gets opened up to Europe, then a lot of the infrastructure, US included, and the tankers that are responsible for trying to get nat gas to Europe just won't be needed as much anymore. Not saying that that's what's happening, but that's an explanation for it. But anyway, LNG coming off the list. And finally, Texas Roadhouse. Outside negative reversal, and look at the volume spikes since their earnings report. There's been more selling than buying. I don't know if this is tied to Chris having a terrible earnings reaction, but anyway, the relative strength very clearly not there. When relative strength is making new lows ahead of price, you got to pay attention to that. Close below the 21, replaced as you'll see shortly, another restaurant stock. So let's go to the new ones. The first 4 are new. ON was a prior leader, broke out, failed while the market was still correcting, formed a 28% base, pretty nice. 2 big up days. Semis leading over the last couple weeks. Relative strength at a new high. This is set up to be a potential leader, and it's liquid enough that institutions would love it. Boeing, we added this in place of kind of the same sector. They're involved in aerospace and defense quite clearly, but the very positive reaction with volume since they announced their projected cash flow for next year brought it to the top of this cup base. I'd like to see a little bit more of a consolidation for a possible buy area. Wing, if you know the saying, Tommy Likey Wingy from Tommy Boy, I can't look at this ticker without saying Tommy Likey Wingy. I like goofy humor. Not sure if that's news to anybody or not, but anyway, Wingstop very clearly acting better in the restaurant space compared to just about any other liquid restaurant stock out there. Oh, you know what I did want to look at pretty quick though? Yum C, possible way to play China without actually playing China, if you know what I mean. This is a U.S. company, but it's a separate conglomerate because it's just tracking the restaurants in China. If they're really opening up and doing the zero COVID, this is an RS new high break out of this flat base, and it's plenty liquid. So this is something that is definitely going on my watch list. That I got sidetracked. So Mobileye number 4, we bought this. Nice follow through today we added another percent to this. Keep it a little bit on the light side of this because it is a pretty volatile stock. But this is a new closing high since its IPO day. So that's an official IPO U-turn cup completed. And we got a pretty good price on this. We may add another percent or two if it continues to act well. So now the carryovers from last week, I thought about putting a stock in place of this IBB, and it would probably be Amgen or Biogen if I did. But I'm keeping IBB on here as it continues, big cap biotech continues to act well, even though a couple of the names near the top of this list didn't have good action today. Caterpillar, this thing just continues to be a beast. When I talk about consolidation should resolve in the primary trend up is up with this very clearly since its gap on earnings. It consolidated, trended higher, consolidated again, trending higher. This is how it should work. This is picture perfect as far as a follow through strength to an earnings gap up. Arista Networks, a little bit of trouble this week. We got stopped on it on the gap down after the Meta said that they're cutting back big time on their spending. Meta is a big customer of ANET. Chart still looks fine though. I know they have other customers, but we're in a capital preservation mode. Arch held on to the 21. Coal's very volatile though. First Solar sold. We did 2 buys on this yesterday. We're profitable still on our first buy. Underwater in the second buy, and the third buy very close to the second buy. Took a third off. Solar's just not acting well today. Volume was heavy early on this. It tapered off later in the day. The losses certainly didn't taper off as it closed right near this 80 MA. Nothing wrong with it, an inside day actually, but when it's your heaviest position and it contributes to you lagging, and I'm not really a fan of this relative strength over the last 2 weeks either. And also seeing Enphase have a massive negative reversal today. Tried to break out, but reversed down 5.57% today. Solars were leading, maybe with the Republicans edging toward possible majority in the House and or the Senate. Maybe just some scared owners of green energy taking some chips off the table. We'll see. Next up, MedP. This has been on here for a while, continues to consolidate since its earnings gap up. Impinj, we still own this, continues to consolidate since its earnings gap up. CEG, couple of a negative reaction to its earnings report for 2 days, and then a big move up yesterday with volume, a pullback today. Don't like the choppy action on that, but notice it did not trigger the 7% sell rule from the base breakout. AEHR, this is one we got shaken out of below the 21 after the bad earnings reports from Wolf, and snapping back in a major way above average volume. This has the looks of a leader. ORLY, O'Reilly, this is what I meant by safe growth, pulling back hard today. This was one of the leaders of the most recent rally off the bottom, but a lot of these safe growth stocks sold off today in favor of more damaged growth, bigger cap names. Sting, STNG, I talked about the entire liquefied natural gas ecosystem selling off over the last couple days. This is included in that. We took our profits on it on the second move below the 80 MA. It undercut and closed right on the 21 today. I'm keeping it on here because I want to keep a close eye on how this behaves. Hess Corp, everybody wants to short oils, and they continued. This is just a normal pullback to the 21 on most of them, and then they bounced at the 21 over the last couple of days. Steel Dynamics, we pyramided to this today when it gapped up 5% on an increased share buyback, and it gave it up late in the day, unfortunately. So we're still positive in our first buy, negative on our second buy on this, but I really like this consolidation after the move up. And again, consolidation should resolve in the primary trend, and this looked like it was early before reversing back into the base. ExxonMobil, perfect bounce off the 21 day, 2 nice days in a row. Eli Lilly, this is just cracks me up. Look at the volume on that. But again, a lot of safe growth stocks did sell off today as part of the sector rotation. You don't like the look of that relative strength line over the last 2 days. Very clearly, this is what most of the value relative strength lines look like, very similar to the Dow. But that story that they're giving away insulin, it did recover back to the 21-day moving average. We'll see what next week brings. Dino continues to act well, and NBIX consolidating after its move up on earnings, and that's your updated 21 over 21 list. And that brings this week's video to an end. As always, love your feedback. Email don@revereasset.com, or the phone is 855-REAL-WEALTH. That's 855-732-5932. Reach out to us with any comments, questions, or complaints. And remember, in the market, it's not how much you make, it's how much you keep. So wrapping up the week ending 11/11, this is Don Vandenbord telling it like it is, just the facts here at Revere, keeping our opinions to a minimum and going with the price and volume and what the market is telling us. Thanks for listening and have a great weekend.